Welcome to today's episode of Peak Market Watch. We speak with market leaders in commercial real estate and related services who have a close pulse on the current market environment. My name is Anton Madley, co-founder and CEO of Peak Financing, and my co-host today is Ben Saddles, one of my fellow board members and principal with Disrupt Equity. That firm actively invests in and manages multifamily properties. We are honored to welcome Yonah Weiss, business director with Madison Specs, one of the leading cost segregation firms in the country. Welcome, Yonah. It's a pleasure to have you with us today.
Thank you. It's a pleasure to be joining you guys.
Yeah. So why don't you give us a brief background about you as well as Madison Specs?
Sure, absolutely. As you see, my background is a brick wall. That's my brief background for the day. But but actually, I was a teacher for many years, part-time stand-up comedian. Not really, just on podcasts. But what I love to do is teach. That's been my passion. I got involved in real estate about 6 years ago, or 5-6 years ago, and dabbled around in different things. I did a little commercial financing for a little bit, some mortgage brokering and hard money loans, and then did some fix and flip, just trying to get my feet wet, learning, apprenticing from some friends and people that I knew who had been in real estate for a long time. And a few years back, about 3 years ago, came across this company, Madison Title. You guys know Madison Commercial Real Estate is a great company, amazing people. And they had a position that they were looking in this cost segregation company. Found very intriguing. The taxes was never really my thing, but I didn't have a background as an accountant, but they have a whole team of CPAs. They've been doing this for years, and they need someone in the business development part of things. And really what it ended up being, I found, was really just like teaching. Like that was my background. So yes, it has a sales component, has business development component to it. But essentially, since it's like this topic, cost segregation, that's like clouded in this really like mystique for people that don't know it. I mean, you guys are laughing because you know what it is. You use it. All right. It's great. But for a lot of people, it's like it's basically a dichotomy, right? For you too. And this was what my first impression was when I came into the space, was that I asked everyone I knew, like, what do you think about cost segregation? So there's two responses, basically. One was like, yeah, it's awesome, right? That's the best thing ever. We use it on all our properties. And then the other response I got was, I've never heard of that. What's cost segregation? What is that? And there was no middle ground. There was nothing. So it was like, and the majority was the latter, were those people who were just never heard of it. And so I found it was just a challenge of just explaining it and teaching it. So I took upon that challenge to just simplify it as best as I could. Been on a bunch of podcasts. I can't even count anymore how many. And that's what I enjoy doing. So I just continue what I love doing, helping people.
Well, all right. So we do know a little bit about it, right? But for our listeners, right, can you break it down maybe in the most simplistic ways? Just because, I think it is, what you really hit on the head is it's a very powerful tool. But you have to use it correctly. You need to know what it can do and what it can't do. And I think for our listeners, can you just kind of break it down for us? And, what is cost segregation?
Absolutely. And you hit the nail on the head there also. There are times when it is appropriate, when it's not. And so let's just break it down. It's a very advanced form of depreciation. That's all it is. Okay. So depreciation.
And what's depreciation?
Exactly. What's depreciation? What is that? It sounds like a negative thing, right? Okay, my property's going down in value. It's really not that at all. It's not the opposite of appreciation. Actually, your property is going up in value, but you get a tax deduction from the IRS called depreciation. And it's based on the concept that things go down in value, but essentially it's not intrinsic to your property's value because it's based on when you buy a property, you literally get to write off that entire value of the property minus the land. So a little bit goes to land, and then the rest of the property you get to take as an income tax write-off. Okay. That's called depreciation, but it's over a long period of time. So it's over a 27.5-year period. You take a little bit every year, but essentially you're just basically taking a tax write-off against as if the property were going down in value. So now I can write off a certain amount to say, well, it's going down in value. So I can, instead of losing it, I get to be able to recover those losses, so to speak. And that's the concept of depreciation, which is a great thing. It basically allows you to pay less taxes on any income you make from your real estate, very simply put. So cost segregation, now understanding what depreciation is just, like I said, an advanced form of that, breaking down the property into different components, that certain things in there actually depreciate at a faster rate. And you can even get bigger tax deductions in the earlier years so that you can pay even less taxes upfront.
So can you give us an example? Can you give us an example of some of the things that a cost segregation study takes into consideration, right? And some of those things that might be in that bucket of, hey, this is going to be more on an accelerated basis versus something that's going to depreciate on a longer term basis.
Absolutely. So essentially what you have is the structure, the main structural components of the building that really depreciate on that 27.5-year schedule. And we're breaking out different components like personal property, including, things like furniture or even cabinets, carpeting, things, even if they're attached, but they're not integral to the structure of the property. So like I said, furniture, appliances, equipment, fixtures, window treatments, even stuff like millwork or certain types of wiring and, electric and lighting, all that stuff, it's inside your building. It all has value to it. We're able to assign through an engineering process, assign a value or really understand what the value of each of those components are, and then take that tax deduction over a 5-year period. And that's called accelerating that depreciation, taking a big chunk of that earlier on.
Yeah, a great explanation here, right? So for maybe for people who have that view, oh, depreciation is negative, right? I think it's important to understand, right, that you have different type of accounting, right? So you have your corporate accounting, GAAP accounting, whatever the mode is, and then you have tax accounting. And what you are really doing with your services is take the maximum advantage of the tax code, right?
Yep.
Exactly. You hear about all the time, right? One of the great advantages of real estate investing is those tax benefits that come along with it, right? What is that? I mean, essentially the biggest thing, Ben, you can speak to this if this is accurate or not, is cost segregation. Like it's the depreciation. Like that's what the biggest tax benefit is, at least in the acquisition stage. Obviously there's 1031 exchanges, there's different write-offs you can use, business write-offs, et cetera, on mortgage expense deductions, but that depreciation cost segregation is a huge part of it.
So people talk about, it's a loss, right? So it's a paper loss, that goes onto your tax return that will offset, real profits too, right? Mm-hmm. And what you're saying is that you're essentially kind of condensing down, instead of taking 27.5 years to depreciate all this stuff and take all of those losses, you're trying to say, hey, first 5 years, I'm going to take majority of those things and I'm going to shove them into the tax returns for the first 5 years. And what we've seen too, and really this is dependent on when you do your cost segregation study, right? We typically try to do it right when we take over the property, right? And that's probably, and maybe you can kind of give some tips to some of our listeners that own properties as well. But
sure,
that year one is huge, right? And then it's going to start kind of going, it's going to go down from there, right? Because you've already taken a ton of that depreciation, you know. But the one thing that I wanted to talk about, because there's strategies involved in everything that we do, and people need to realize when to do cost segregation and when not to. So maybe can you kind of talk us through, because people are going to be like, oh, I've got a commercial property, but it might not be the best fit for cost segregation. Exactly. And so can you kind of talk to us about kind of the times when you might not want to do it, or you want to at least think about doing it?
Sure. Absolutely. And I love that you called it, a strategy, and you really do have to. That's what it is. It's a strategy. Yeah. It is not necessarily for every situation and you do have to combine some other strategies on the exit sometimes in order to really maximize the benefits. So my general rule of thumb is, and I'll get into the reasoning for this, but is any property that is purchased for over $500,000. So this is going to exclude a lot of smaller properties, first of all, and you're planning on holding the property for at least 2 years. So there's really two components to this. The first one is obviously it has to be a certain amount, because as you said, when we're able to front load a certain percentage of that depreciation to those earlier years, then, the bigger or the more expensive the property is, the more of those tax deductions proportionally are you going to be able to take up front. So the smaller, lesser the value, the less tax deductions, the less benefit is going to be, because there's a fee involved in the service, although it's not a really big one whatsoever, and almost nothing compared to the tax savings. But the smaller the property you get, the more that actually comes into play. Is it worthwhile or not? And that second factor is how long you're going to hold the property for. And the reasoning behind that is because there's something called depreciation recapture tax. Okay. So when you sell a property, you have to pay a tax on the unrealized gain. Okay. So besides for the capital gain, what you've actually realized, you've made profit on the sale, you have to pay a tax on that amount, or you're subject to that tax. You're also subject to what's called the unrealized gain. The amount of depreciation you took, are taxed on that as well on the sale. Now, there are strategies to get around that or defer that, like a 1031 exchange. You can defer that tax. You can also, find other ways to get losses from other properties. The great thing about real estate is that if you are a real estate professional, and this is something that is another really important component here, that this is when it's going to make sense the most. Okay. If you're not a real estate professional, then, which means you're involved materially participating in a real estate trade or business, then you're limited to use those tax deductions against your real estate income. Okay. So without getting too complex over here or too deep into, tax code, income from real estate is called passive income. Okay. It's different, treated differently than any active income, W-2 income you might have. And that is a great thing. It's passive income. It's on your Schedule E, and any depreciation you have is going to be used. That's called a passive deduction or passive loss is going to be used against that. If you had more deductions than you actually have income, let's say you do a cost segregation study and you take what's called bonus depreciation to get that huge front load in the first year, and you get $1 million of depreciation, but you only made $100,000 of profit, right, of net operating income from your property. So what happens to that extra $900,000 of deductions? Does it disappear? Like, what do you do with it? Can you use it? And this is where a lot of confusion I get. I mean, I see this on Bigger Pockets, like at least once a week, this question comes up is like, well, can I use depreciation against my W-2 income? And the answer generally is no. Yeah. Okay. There are exceptions to that. And again, if you're a real estate professional or your spouse is, then that is a possible way to do that. But generally speaking, passive deductions against passive income. Okay. Those extra losses will just carry forward. You'll just use them in the future years. Okay. And they don't go away until you sell the property. So that's another time to create these extra losses are great. If you sell the property, you can use those losses to offset the gain, the tax. But another strategy that you can do is even to get the cost segregation done. But nevertheless, you do want to make sure you're going to talk to your CPA to make sure this fits with your investment strategy and with your overall picture.
So, the recapture is something that, a lot of people don't really understand. And we've had to educate a lot of our investors on that as well. Right. And I think that plays into when do you do it? And, is this part of your overall exit strategy? I kind of look at it like, if you're going to sell the property, correct me if I'm wrong, this is just my assumption, right? Okay. If you're going to sell the property within the first couple of years, cost segregation might not be the best strategy for you, right? You're going to get a little bit year one, but if you turn around and then sell the property, you've got a ton of recapture that your investors, now we have a different tax strategy, and I'll kind of get into mine as a real estate professional and as a, full-time syndicator. But for my investors, they're going to get hit. They're just going to turn around and get hit with it.
Right. They'll get that deduction, but then they'll get hit with the tax on the end.
So, I mean, I look at it like, okay, if it's going to be maybe more of a longer term, let's call it 4 to 7 years, it makes more sense to do cost segregation at that point, right? Because you're going to be able to, actually benefit for a little while from that depreciation, right? That's less money that you have to pay the tax guy.
100%.
And, so, I mean, I kind of look at it like that. And so that's kind of been the misconception where people automatically on every single deal think that they should do it. But there's strategy for everything, right?
Yeah.
So that's, but the way that we look at it too, right, is, we have gains from sale of property, right? And then I turn around and I buy deals and I get depreciation from that. So it offsets a lot of this, right? I'm using it almost as my built-in 1031.
Right.
And everybody's tax situation is different, right? But if you're getting a bunch of capital gains from sales, but you're buying a bunch of deals and you're doing cost segregation on them, then guess what? It's going to net out in a lot of ways, but and some of those losses are so big that you can't even take them in 1 year. You're just bow waving them, into the future.
Yeah, they'll just keep, adding up and adding up.
No, it's a tremendous amount, right? And I think the other thing too, to kind of bring up, is, and this has been a debate amongst syndicators too, right? Do they get, or should they get the benefit of the depreciation, or should that flow 100% to, and I'd like to have both you guys' opinions on this. Should that flow 100% to the LPs or the investors in the deal?
Mm-hmm.
So I'll start with you, Yonah. I mean, what do you think about that? What's your stance on that?
Sure. I mean, there are two definitely different opinions, and it really does have a lot to do with two things. Number one, how you structure the operating agreement. Okay. And however you do structure that, that's going to determine, how that depreciation is going to be allocated. Is it going to be equally, among the equity ownership, or is it going to be solely to where the money is, right? Some people say follow the money. Wherever the money goes, like that's who's going to get it. So there's really those are two different opinions there. But either way, I think is, for lack of a better word, kosher, right? They're both considered appropriate and, can be backed up by different things. Whether or not, I'm not sure if your question is what is the, appropriate.
What's your opinion?
Like,
what do
I think?
Stance, yeah. What's your stance, right?
Yeah. I mean, I think if I'll just, interject my opinion here, I think the syndicators are doing a lot of work, and the ones that are really what's called materially participating in the real estate. I mean, they're running the property. That's exactly what's called real estate investing. They should be getting the tax benefits that come along with it. So it should be, as far as I see it, according to the equity ownership.
All right. So my colleague's usually a little bit more conservative. Anton.
Yes.
What's your stance on this thing?
So certainly, obviously, from a syndicator perspective, that's what you want to hear, right?
Right.
So from the question is what ultimately, and I'm not sure whether it really has been tested in court, right? Whether that argument will stand or not, right? The safer approach definitely is as you mentioned, Yonah, to follow the money, right? So what was the original cash equity contribution and do it along those percentages. But naturally, I understand that from a syndicated perspective, and you do not just have that in real estate, you have that in other businesses too, right? So all the hedge funds have very similar issues with the investments that they are doing. And naturally, they want their portion, their override that they are getting, that they'll have the benefit of depreciation, whatever, or other tax benefits, whatever the type of business is, not just real estate, but others too. So I would say the conservative side definitely is the money, but the cash contribution. But if your tax consultant is comfortable with it, then I would say go with the first version where the sponsors have the benefit as per their 80-20 split or 70-30 or whatever it might be.
Right.
And I think the bigger point that I'm trying to make is, right, it's dependent on the sponsor, depending on the operating agreement. Investors that are listening to this podcast, they need to review that, right, with not only their lawyer but their CPA, and understand how that's going to work for them, right? Because I think you also brought up a good point too, Yonah, that I want to kind of drive home, right? If you're not a real estate professional, some of these losses are just going to be kind of in suspense.
Right. You can't even use them. Exactly.
Yeah, they're just so, a lot of people talk about, we're going to do a cost segregation study, right? But if you can't use and nobody should ever try to bake that into any kind of returns, because everybody's tax situation is different, right? But I love how we see some sponsors that will say, you're going to be able to write off 75% of your, your initial investment. I don't know, what that really means, right? Because each person's situation is different. But I think the point that I'm trying to make is that investors need to understand that it might not work for them at all. Maybe it will, maybe it won't. It just, once again, depends on your tax situation and what, designation you are, right? Are you a real estate professional or are you not?
Yeah. So Ben, you brought really up an excellent point, right? Read that operating agreement and understand it, right? So whatever the decision is, right, of the two options, the sponsors obviously will have to make that decision, right? Do the sponsors get the benefit of that depreciation? And you need to know that as a passive investors, right? It's similar to that other discussion that we constantly hear, right? Which is return on capital and return of capital, Right?
Mhm.
That's another topic where a lot of passive investors only get that big wake-up call once they get distributions, and particularly when the property is sold, and suddenly realize, well, but that's not what I thought that it was signing up to, right?
Mhm.
So it's
And
all about read that operating agreement and actually understand it.
Understand it. Yeah.
so
Only.
I was going to ask Yonah
Yeah.
real
Go ahead.
quick, man. So, about the process, right?
Sure.
And I've gone through this, but I'd like you to kind of explain it to our listeners as to, when should a sponsor or an owner reach out to you? What types of properties is this most beneficial on? And, how long and what does that process look like? I know there's several questions in that one question, but, maybe we'll start off. When should somebody engage you?
Yeah. I mean, it really does depend. The best time, and like you said, a lot of people like to get it done in the first year immediately after taking over the property. And it is really best in many situations to get your taxes set up the right way in your first year of tax filing. So that's why a lot of people like to get it done. There is another component there, which is that when you're doing a major renovation or even capital improvements on a property, if you get the conservation done on the acquisition, there's actually a second component that can be applied to renovations that have been done subsequently. So it's best to get the conservation study done, as soon as possible, so you can capture what the property is and how you can depreciate everything in it as is. And then when those renovations or updates are done, you can now capture the depreciation on that later on. So that's the first thing. The second thing I would say is that it, like I said, it does depend, because you don't necessarily even have to do it. There's no rule requiring you to do it in the first year. And so for some people, if your property is not really operating in profit, for example, then to get extra deductions doesn't necessarily make sense. It may make more sense to get it done in the second year. And you don't really miss out on anything. You actually can catch up whatever depreciation you missed, you could have taken the previous year. And all that can be done without amending your tax returns. So you're really just changing your accounting method, making an adjustment with a special form that's done. And that's done in a lot of ways. A lot of people do that even 2, 3, up to 5, or even 10 years back. If they're holding a property for a long time, they didn't need those losses. Now suddenly they come into a huge profit of some kind and you need those losses. It's a perfect strategy in a situation like that, where you may not have needed it at a certain point. Maybe, like you said, you had like this abundance of losses, but what happens if, you didn't sell or whatever, and you held properties, you didn't acquire anything new for a couple of years, and now all of a sudden you need those losses. It's a great strategy to get it retroactively.
What types of assets, though? We're mainly in the multifamily sector,
Right.
where it makes a lot of sense to do this, right? Is there other asset classes where maybe it's you can still do it, but you don't get as much benefit? You're just trying to kind of give our listeners some perspective as to, if you have this asset class, you should reach out to Yonah.
It really can be done on anything, on any asset
Okay.
class whatsoever. And I mean, we're the biggest at this point, the biggest national conservation firm. And so we're doing like about 3,000 of these a year. We've been around for a long time. So we do literally everything. I mean, there are certain properties that do have more benefit than others. So I'll give you a typical example for multifamily. As you're probably aware, you're going to get on average about 25 to 30% of that accelerated depreciation, which means the amount that you can take as a faster depreciation from the structure, which will remain on that 27.5-year schedule.
Mhm.
For probably the worst type of properties that you could do, which may not be beneficial at all, are like warehouses, where there's not a lot of personal property in there. Okay. It's usually just kind of bones, right?
Yep.
In that situation, yeah, you might be able to get 5 to 10% in some cases. Or if there's a lot of land improvements, which, landscaping and pavement, that gets a 15-year schedule, that can be deductible upfront as well. That may be appropriate. However, warehouses are probably like the least on the bottom rung of like least beneficial properties. Single family houses are less than multifamily, although can still be beneficial. Again, it can have to meet that threshold of, is it expensive enough? Is it worth enough to get those benefits? And then on the other end of the spectrum, and everything in between, office, retail, self-storage, all that stuff is really, really beneficial along the same lines of multifamily. But on the other end, where's like the highest, best possible property, I mean, you have above multifamily, you have like hotels and assisted living facilities, which have a lot more equipment and a lot more, furniture and fixtures and things like that. And then even higher than that, you'll get, very expensive manufacturing facilities that have, again, lots of equipment and things. And then even above that, you'll have mobile home parks and golf courses. And so those
Really?
two asset classes are really, really unique.
Well, let me ask you about the mobile home parks. I was under the impression that would be less, right? Because it's mainly you own the land, but maybe you don't own the homes themselves. You
Right.
know, I mean, I guess why would you say that that's higher than those other asset classes?
So typically, and I'll tell you exactly why. Typically, we're seeing, just to give you a perspective, and it's been a very hot asset class recently, as I'm sure you're aware, right? Mobile home parks, whatever you want to call it, manufacturing housing communities. Typically between 50 and 80% of accelerated depreciation on mobile home parks, as opposed to your 25 to 30% on multifamily. The reason why that is you typically have two scenarios in a mobile home park. You either have what's called park-owned homes or tenant-owned homes, or a combination of both. So let's take the most common is usually what's called tenant-owned homes, which means you buy this, park, this piece of property, and on it are these concrete pads, and on each one of those are these dinky little mobile homes, right? And the tenants own them, so they're owned by the tenants. You're really just renting out the space to them. That's the typical, that's the classic case of a mobile home park. Now, in that scenario, if you think about it, what do you actually own? You own the land, like you said, but you also own the land improvements, and the land improvements, which I mentioned before, depreciate on a 15-year schedule. That's accelerated depreciation. A lot of that, you're talking about the roads, the landscaping, the pads under each home, right? Concrete, gravel, whatever that is, fencing, anything outside, all of that you own. And that's essentially what you have. Of course, you're allocating a certain amount to land, but what else is there? There's just the land improvements. So that's why if you buy $1 million park and all you own is the land and the land improvements, and there is some infrastructure things sometimes that is on a 27.5-year schedule, like some concrete, things, or even the infrastructure of the plumbing or main electric or, sewage. But the majority, like I said, 50 to 80% is in that land improvements. And so that can be taken as first year bonus depreciation. It's, it's out of the park.
I love doing these things, man. See, I'm learning some new stuff too.
Yeah.
It's great. I was under the impression it was the opposite of that, right? That there was going to be very little that you could use a cost segregation study on. So,
yeah. So you mentioned also golf courses. So there, are you telling us that the greens and the fairways, that they're also part of that so-called land improvement that you can depreciate over 15 years?
Exactly right. Same exact thing. Exactly right.
Okay. So now we know why some famous people invest in golf courses.
That's right.
No politics, man. No politics. All right?
Smart. No, but how can I get the most possible, tax deductions? Accountants buy a golf course. Okay, let's learn how to play golf.
There you go. There you go.
And really, politics aside, you would be surprised, Ben, how many people on both sides of the political spectrum are invested in golf courses.
I guess, Once again, I'm learning something new. I love it. I mean, not quite there. Can't buy my own golf course yet, but hopefully in the future, right? But all right, so kind of getting into a little bit, not a political question, but just more about what you see in the future, right? I know there's been a lot of news about, the new administration might be changing up some of the rules, and, some of the stuff from the old administration might be going away. Which way is the wind kind of blowing? And what are you guys hearing? Being that you guys are one of the biggest shops in the country, if not the biggest shop doing cost segregation, obviously you guys got your ear to the ground on this stuff. And
sure,
let our listeners know, is this strategy going to change in any material way in the future?
Yeah, absolutely. And, and we're in touch with accounting firms across the country, and as well as, some policy makers as well. And we have also the Madison 1031 company, which, with the attorneys that are on that, are also very closely involved with policy going on with the 1031 exchange and whether that's going to go away. I will preface by saying that the Tax Cuts and Jobs Act that was under the Trump administration, right, that made a huge difference with that 100% bonus depreciation rule that came out. That is already in the books to start phasing out in 2023, which means we have all this year, all next year to take advantage of that. 2023, it's in the books already to start going down to 80% bonus. And then after that, 60% until 2028. It will no longer be, according to the current law, any bonus depreciation. Now, I tend to not believe anything politicians say during campaigning.
Good.
To be honest, I don't pay attention to anything during campaigns whatsoever, but they're just notoriously liars. Okay. And so everyone knows that. It's no surprise. But so to say, and to quote, the president, who said on day one, I'm going to repeal the Tax Cuts and Jobs Act and everything in it. Well, obviously that didn't happen, right? And everyone knows that that's a joke, because you can't make an executive order like that to repeal a huge tax reform. It has to pass through Congress, has to pass through the House. There's a whole process of making big tax reforms. And the fact that it was the biggest tax reform in like 30, 40 years, that's not something that, and that Congress and both sides of the aisle like agreed on to pass those laws. It's not something that you're going to just, do away with. Obviously, yes, there are some tweaks. There are some things, they have policies, they want to change certain things. Understandable, right? But to go ahead and wipe out the whole thing. So in that, I don't think bonus depreciation is going to be touched whatsoever. Cost segregation obviously has been around for decades, and that's not going to go away. Whether you like it or not, a large amount of politicians, Congress people own real estate or invest in real estate. So they have a vested interest to make sure that this stuff is not going to go away, whether you like that or not. But that's just the reality.
No, and I think it goes back to, you made up a great point, right? There is a ton of people that own commercial real estate that are influencers, right? Mm-hmm. And so they'll say one thing in public, but in the back rooms they're saying, no, we're not going to do that. You know why? Because I own a bunch of that stuff too, right? And so, and I think, it's the tax code, right? People can get upset. People got upset about Trump's tax return, but we now realize the reason that he was able to only pay whatever it was, $750 or whatever it was, something crazy. And people got mad thinking that he was somehow taking advantage of, that's the tax code. And cost segregation, like you just said, has been around. I feel like it's been around for like 100 years. It's been around for a while. And so this is not anything new. The bonus depreciation, like you mentioned, is new, right? But and let's maybe take 1 minute and kind of explain that. I kind of look at that as it's like turbocharging the cost segregation, right? Is that correct?
That's right. They're one and the same. Once you've done a cost segregation study and you have allocated those assets to those faster lives, anything that depreciates on a faster schedule, you have the option to take it all up front in the first year. And that's called 100% bonus depreciation.
Okay. So I wanted to ask you a kind of a one-off question, because, being that I'm here in Houston, Anton's in Dallas, right? We have a lot of exposure to oil and gas, right? And, I know I'm getting a little bit off topic here, but, some of these people, as part of their pitch to invest in these oil and gas, projects, are saying, you can get 100% year one, right? Now, is that because of all the equipment that they have, or what? Do you guys have a lot of experience in that realm?
There is. There are different things. So, cost segregation, depreciation in general. Depreciation has different forms in different industries. So Real estate, obviously, land, real estate, real property depreciates. And so that's how you can segregate the cost of the different components. Oil and gas have other different tax incentives as well, in terms of the equipment. Yes, can be taxed, can be, written off at a faster rate. So there are huge tax incentives. I would say it's probably maybe debatably the biggest tax beneficiary industry out there. However, the difference is that the returns aren't necessarily always the same. So yes, there is the huge tax advantage when it comes to oil and gas as well.
Yeah, I think you made a great point, right? So I have invested in oil and gas, right? So I have had the advantage of those tax benefits. But the reality is you get these tax benefits when you actually drill, Right. So, and drilling by its nature is risky. So you need to provide tax benefits so that you essentially can balance that risk that someone is taking.
So it's an incentive, right? You
Yes,
know,
absolutely.
I mean, and I guess really is cost segregation. That's a good point, right? You know, it's cost segregation, and you know, it's an incentive to invest money into these properties and keep up with them, right? I mean, I think that's the meta point here, right? Which is what drives commercial real estate and multifamily. It's like you have to incentivize entrepreneurs and investors to put money into these properties. Then sometimes it's not just necessarily you incentivize them through. It's going to be a profitable thing, right? You know, just trust me. There has to be some tax, you know, benefits that go along with it too. You know, and I think that's why cost segregation has lasted so long and will continue to last into the future. You know, because you have to have more than just, hey, go buy that property and keep up with it. So, well, I've really enjoyed it, Yonah. I mean, this has been, I'm like I said, I've learned several things today that I didn't know about. You know, but Anton, was there any other questions that we had?
No, not really. Right. I think obviously we want that our listeners can reach out to you, Yonah. So please provide your contact information. But before you do that, I think it might also be helpful for the listeners to understand that they can reach out to you early on when they have a deal under contract, so they do not have to wait until they already closed on the deal and now think about cost segregation. As a matter of fact, it's very beneficial to reach out to you before you actually go down that rabbit hole of closing, so that you can strategize right from the get-go.
That's a great point. Yeah, I'm glad you brought that up. Absolutely.
Yeah. Okay. So, Yonah, how can our listeners reach you?
Best place to find me is actually LinkedIn. I'm extremely active on that platform, as any of our listeners, if you know me, know that. So that's the best place. Make sure to put a little note that you heard us on the Peak Market Watch podcast. And you can go to my website, yonahweiss.com. Obviously, I work for Madison Specs. You can check out more information there at madisonspecs.com, or just reach out to me personally.
Awesome.
Right. It was a pleasure having you with us. And that's been said, you shared with us quite a number of great snippets, and really appreciate your time.
Thanks, Yonah. We appreciate it, buddy.